Welcome to this webinar series, which is a part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. Most experts advise investment in systematic investment plans of mutual funds, and they have indeed become very popular. In fact, the term SIP has become so popular that new investors sometimes do not realize that this term was popularized by mutual funds. And, sometimes they end up buying other products in the name of SIPs. So today we have three experts who will help us demystify SIPs in mutual funds to understand how they can be part of your investing strategy. So let me first introduce my panelists to you. First of all, I would like to welcome Mr. K.S. Rao, who's the Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Mr. Rao has been striving to take financial literacy and investor education to various demographic segments across geographies for over 30 years now. We also have with us Mr. Amit Trivedi, co-founder OSAT Knowledge Private Limited. He's authored a number of books such as Riding the Roller Coaster and Investories. Last but not the least is Harish Rao, who's also the co-founder and director OSAT Knowledge and a money management coach at Simple Equation. So let's demystify mutual funds SIPs for you today along with our panelists. Welcome to all of you, gentlemen.
Thank you.
So I'll start with you, Mr. Rao. So everyone knows the term SIPs these days, but what, according to you, is the essence of SIPs? How does one understand what it is about?
Thank you so much, Nidhi, for having me, and glad to be part of the webinar. Joined by Harish and Amit bhai. It's indeed, it's always good to have these conversations. And I was also looking at when you said SIP as a theme, for the webinar, we were just looking at, it has become a household term today. People understand SIP more than the mutual funds. People say I have invested in SIP rather than I invested in the mutual funds.
Absolutely.
The number of people who say it very differently. The popularity of SIP has gone that way. As you said in the introduction, today some of the products beyond mutual funds also say, this is an SIP. In fact, I was in a place, it is in Kolkata. We were doing one big conclave. This is a Chamber of Commerce. Outside the Chamber of Commerce, there is a a nice pub which says, today you can sip up with us. That's the way the SIP has become popular. It was it was right across in front, and we were just looking at SIP can understand in a very different way. But coming jokes apart, today the SIP has become a strength for even for the Indian capital markets. Thanks to mutual funds IA campaign, thanks to the awareness in the financial literacy, we get little over 25,000 crores of money every month through the mutual funds through the SIP route, around 10 crores of folios which are there. Means the popularity is immense. But demystifying this, it's like one need to understand. SIP is a simple methodology, and somebody is investing a fixed income, fixed amount of money periodically, either for a fixed term or for a term for the lifetime. And how one can utilize SIP, how one can work on SIP. Probably I say the SIP for me is your first step into the prosperity. You are just automating your savings. When I'm reading this book of James Clear, Atomic Habits, probably, four things when he says SIP looks very obvious. It is for fixing in that four things. What he says is make it obvious and make it attractive and make it easy and make it simplified. And today, if I can look at SIP, it's a make it obvious. If I have to have my retirement goal, it is a retirement goal. My SIP for the retirement goal, make it obvious. And it's a make it attractive. It's like, I have an advantage today. I can invest the fixed amount today. Or tomorrow, if my increment comes in, I can step up my SIP. And it's making much more attractive. Or if there is a situation like COVID comes, when the salary for some people stops, I can even stop the SIP and re-continue the SIP. And it has become much more easier, even with a 500 rupees, I can do SIP. I can, for each of the goal, I can make it, it's a more. And how it is satisfying, when we were promoting, I think most of us, me, Harish and Amit, we are part of the sales for the long number of years, 20 years back or 25 years back, I can say pre 2000, when we were promoting SIPs, it was very difficult for us to convey because we were talking about dollar cost averaging, which we borrowed from the global world, and we probably converted into the rupee cost averaging. But people don't even understand what is the rupee cost averaging. And it's a method. But now people having experienced one, markets are always volatile. Markets will you can get more units in the downturn when you get lesser units, but you are continuously investing. People have seen the power of compounding, how that SIP can work, and how that SIP can be a true wealth creation. And you don't need to manage, you're automating your savings, and you just don't need to manage your emotions. I mean, it's like business happens. If the market corrects 1,000 points or market costs 10,000 points, my SIP happens. And the good part it has happened is, during COVID, that long downturn, people got accumulated more. In fact, if I can look at some of the index funds, people who have invested one-time investment have got lesser return than the people who have invested through the SIP route over a period of time. That's the power of SIP today, I look at.
Yeah, so Mr. Rao has very succinctly put in a very comprehensive manner how flexible SIPs are, and how they help, the power of compounding, how they beat index funds over a long period of time, etc. So apart from these, there are many other benefits that the industry talks about. So Mr. Trivedi, could you help our viewers understand how do SIPs help, and what is really the rupee cost averaging concept with which Mr. Rao also referred to?
Thanks for this wonderful question, Nidhi. And first of all, as we move in from 2024 to 2025, best wishes to everybody for a grand future. And now coming to the question, SIP, uh, there are two basic principles that work. One of the principles is the power of compounding. The second is, as Nidhi, you asked, it's the rupee cost averaging, or what Rao sir also said, way back in early 2000s, we were talking about the dollar cost averaging. Essentially, what it does is, and it especially works when the NAVs are fluctuating, which is more towards the equity-oriented funds. You invest a fixed amount periodically, and typical periodicity is monthly. So that becomes the first advantage, that most of us earn a monthly salary. Many of us, our bills are paid on a monthly basis, and hence the difference between the two, which is the saving, also happens on a monthly basis. Now, if you automate atomic habits, and that atomic habits, or rather automatic habit, becomes the atomic habit. And to that extent, you simply channelize your monthly savings with a single instruction into recurring investment on a month-on-month basis for whatever foreseeable future, with the amount of flexibility which is unmatchable. Because, as again, repeating what Rao sir said, you can increase, you can decrease, you can stop, you can restart. All these flexibilities are built into this entire process called SIP. And then when you invest a fixed amount, because the NAV keeps going up and down. Now let's look at that NAV going up and down for a moment. The fear is very real when people see the value fluctuating. We are not used to seeing volatility as such, and we want a linear growth, and that's how the minds are wired. But NAVs are volatile. Now, in case of an SIP, because the NAVs fluctuate, but the amount invested is fixed, the fixed amount divided by the NAV is the number of units you get, which means when the NAV is low, the investor buys more units. When the NAV is high, investor buys fewer units. Automatically, the volatility which is scary is turned from a foe to a friend. At cheaper levels, you buy more. At costlier levels, you buy less. What can be smarter than this? So SIP automatically, converts a lot of risks or the fears into one's advantages. Add to that the power of compounding that works in the long run, and you've got a lethal combination where your average cost keeps coming down, and over a period of time, all the units bought at those lower prices accumulate, and they enhance the value of your total portfolio. So that way, SIP is very simple, easy to understand, but the benefits are enormous.
Right. So those were the benefits of SIPs that Mr. Trivedi put forth. Of course, it builds a discipline of investing, like he was mentioning, month on month. As soon as your salary comes, you can put a portion in SIPs, and your investing will be taken care of in a way if you plan it right. And of course, the rupee cost averaging, I think he explained it very nicely that, how the number of units will be more when, the markets are down and so on. But Mr. Rao also mentioned, Mr. Trivedi also mentioned that, SIP comes with a flexibility where you have the option to increase or decrease the amount you are investing. That is only one type of flexibility. So, Mr. Harish Rao, I'll come to you now. And, I would want you to talk about the kinds of SIPs available in the market. So there is top up, there's something called trigger. If you could just explain a few of the most important ones, that will be great.
Thank you, Nidhi, and wonderful presentations at your and a galaxy of speakers alongside me. To end the year 2024 and begin 2025. My best wishes to your team for much success with all your endeavors in 2025, and for the viewers and investors as well. Mr. Rao, was alluding to James Clear's Atomic Habits. Okay, so that's like a Bible, or a very inspirational book for patient and disciplined people. Or if they don't have that book, tells you how to build it. Okay, there is and I think even Mr. Trivedi had talked about it. Yes, there are various types of SIPs. The one that Mr. Rao was talking about was a plain vanilla one. That is a normal SIP, assuming that you say give a mandate for a investment on the first of every month. Okay, so in the American parlance, this is called pay yourself first. Okay, so and like Amit Bhai was telling, this promotes a lot of discipline. So before the usual, the formula is expense, income minus expenses equals savings. So in this case, if on the first of the month the money goes, it becomes income minus savings equals expenses. So you pay yourself first before you pay others. So that's your plain vanilla SIP, which you do, in the beginning of every month, or if you want on the 7th or 15th. That's a normal SIP. Then you have the top up and step up. Essentially, they are the same. This is a very innovative, and this is also a very automated way of increasing your savings. So assume that you feel that you would be increasing your salary, you'll be increasing your earnings every year. So you can give a mandate to the AMC that they increase the SIP amount by a rupee value. Say you started with a 10,000 rupee SIP. So from every year you can increase it by 1,000 rupees, or every 6 months you can increase it by 1,000 rupees, or you can give a percentage increase. Okay, so I want a 10% increase every year. So if you factor in stuff like increasing increments or earnings. So this is step up or top up. Then you have a flexible SIP, which you were talking about, Nidhi, in which you can actually, this typically applies to online SIP registrations. Depending on the AMC, you can ask them to, suspend a particular SIP or change the amount that you're investing, okay, based on your earnings or your bank balance or the surplus that you have in your account. So this is very useful for people who are having business income, or who have, liquidity issues with their earnings. Then you have something called a trigger SIP. Trigger SIP is when you give a, say, a trigger figure, like probably a NAV change or an index change. So if the NAV of the fund is, say, 20 rupees, you will mandate that if the NAV falls to 15 rupees, you will trigger a SIP. Okay, so this is real value buying, that you are looking for a big drawdown in the NAV value, and at that point in time, you will trigger a purchase. Though it may actually not be as simple as it sounds, that, I give a trigger at a very low value, because like Rao sir and Amit Bhai also would agree, this is tantamount to trying to time the markets. Okay, Only no one knows what will happen with the investors' emotions in the journey from, say, a 20 rupee NAV to a 15 rupee NAV. Okay, there would be tremendous amount of developments in the market at that point in time. The news flows would also be very, very different. There would be, his own mental triggers, making him skeptical or enthusiastic about the market. So an investor has to be very careful of his own emotions when he goes for things like, a trigger SIP and, a flexible SIP. In my opinion, the best SIP is, a plain vanilla SIP or the one with a top up or step up, so that you are committing to a higher inflow into your investment account. I think these are the best SIPs. There used to be a perpetual SIP which has been discontinued. You have to give an end date which cannot exceed 30 years now. So, which is like a really long-term or a generational SIP. Okay. A variant of this could be an STP, a systematic transfer plan, in which you could do value averaging. I'm not too sure if all the AMCs are offering this, but when I had invested a few years back, there was this value averaging concept, in which case when the markets fall, a higher amount would get invested. Okay, so Amit Bhai was talking about rupee cost averaging. In value averaging, it's not a fixed amount that goes in every month. When markets fall, an even bigger amount goes. And when markets increase, a smaller amount gets invested. So that is real, genuine value averaging. I'm not too sure whether all AMCs uniformly offer value averaging. And that typically happens if you opt for STPs, not SIPs, because you need to have a surplus in your feeder account.
Right. But one point of confusion, Mr. Harish Rao, is that STP typically we see it, or even our viewers would understand is as systematic transfer plans, where
Yes.
you usually, are you referring to the same, or is
Yes, I am referring to the same. The principle is the same, Nidhi, between an SIP and STP. In STP, just that the amount comes from a different feeder fund
right?
to an SIP.
So another aspect in the investing journey, which is very important, is diversification. It is the cornerstone of investment, so to say. So, Mr. Rao, what role can SIPs play when it comes to diversification?
Thanks, Nidhi. Taking the clue from both Amit and Harish, the whole purpose of investing in mutual funds predominantly is for the diversification. Anyone where I'm investing, and when I'm investing in SIP, I can look at diversification in multiple ways. I look at today, because one, if I am having goal-based investment, I'm already diversifying my multiple SIPs. For each goal, I have an SIP. Then I've already diversified my goal-based investing. Second, when it comes to the various asset classes, probably I define sometimes this SIP. You do SIP in SIP. What is that SIP in SIP is your S is the first S is in the savings. For example, I pay a little over 2.5 lakh rupees as my insurance premium in a year. And I invest roughly around 20,000 rupees in a liquid fund through SIP route. Means I am diversifying my money into the liquid fund, because liquid fund invests in the various money market instruments. And second, it is according to my goal, it is on the money market funds I am investing. Means I have diversified to money market funds. Second, as I part is my investment. Investments is for my investing my financial goals. It could be a child education, it could be a holiday, it could be a retirement fund. Or, I am putting my money. I'm again diversifying into the various investment asset classes. One could be highly risky. When I'm looking at my retirement fund, it is a long term, and it's going to be partly a small, mid, and the kind of a risk which I am taking in. Or when it is a very short term, I am looking for funds like a balanced advantage fund, and then my diversification has happened according to my risk mitigation of my each of the goals. And the last, one I have also put it like the P part of the SIP is of my philanthropy part, which I invest predominantly into the index fund. My simple logic is, when I am putting my money into the index fund, when Indian economy grows, this money grows. Means, I am contributing to the philanthropy, even nation is contributing to the philanthropy, which I intend to do. Means I diversified in the other way too. Means SIP as a tool to look at diversification in a multiple ways, and it is making much more easier, much more obvious. and then your risk mitigation is much low high better, and it's and you're optimizing the returns, but optimizing the risk too. And I personally feel, I mean, when you say don't put all eggs in your basket, SIP is the best way to work for every one of us. I mean, either it's a goal-based diversification or investment theme-based diversification or term-based diversification. And in any case, every investment I do into the mutual fund itself is diversifying.
Right. So that is very interesting, the kinds of diversification that you have talked about. So the next question that I'm coming with, Mr. Trivedi, it is for you, that we did discuss that how index funds kind of underperformed SIPs over a long period of time. There was an example. But still, there is an argument sometimes that, lump sum investment during dips may be a better option than sticking with SIPs. So do you think so? And if not, then what is the reason behind that?
Looking back, and when we are looking at historical numbers, it's always appealing to see that when the market dipped, I invested additional sum, and that went up. But like Harish beautifully explained when he talked about those triggers, that when the NAV drops to a certain level, market levels drop to a certain level, that's when you increase. Is that really possible at that point in time is the question. Some people are able to do it, not many are able to do it. Even when somebody has the mental wherewithal to invest on the dips, there needs to be a surplus of money available to invest at that point in time. Right. So let's take a recent example of now not so recent, but what happened in 2020 during COVID time, when the index fell by more than 35-40% in a span of a couple of months between January and March, just when the lockdowns were announced. A lot of people felt that this is a huge drop and a major opportunity. And some experts advise that this is the time to even borrow money and invest. Now, that was a very aggressive call that somebody had taken. Now, that call turned out to be right. Assume that somebody wanted to do it. The problem was, if the job is at stake and the salary is not visible or income is not visible, in that case, does that make sense to borrow money and add just because market has provided that opportunity? The market would bounce back, but will it bounce back in a hurry like what happened in 2020? Or will it bounce back like it happened between 2009 to 2014?
Right.
Yeah, which was a 5-year period. So you don't know. Theoretically, it sounds good. So if your finances permit, if your psychology permits, then buying on dips is a great idea. But I'm repeating, if your psychology and finances both have to permit, because suppose that you entered a little early and the wait period is long, waiting for that long period is equally painful. A lot of times, those spikes are less painful than enduring the pain for longer duration. So be very clear about these things. A lot of strategies that people talk about, a lot of fancy stuff sounds great. You can come up with Excel sheets and numbers and make it look appealing. But like as Harish was mentioning just some time back, the best SIP is the simplest plain vanilla SIP. Because it is going back to the atomic habits example that Rao sir mentioned. It is something which is easy, simple, and actionable. Rest all requires one to develop thick skin at the dip of the market when everything looks doomed. There's this old saying which says the best time to buy is when there is blood on street. And somebody added that even if the blood is your own, that's the best time to buy. But when you're bleeding, how many of us have the capability to sign that check? Right? So theoretically, yeah, it's a good idea. Practically, check your psychological and financial ability. If your finances are in order, then by all means go ahead. And number one, If you are unable to decide, then go to an advisor, take advice, let the advisor check the finances or a mutual fund distributor and help you in taking a decision.
Right.
Right.
So buying on dips, sounds like a great idea, but Mr. Trivedi made a very, very important point. Only if your finances and your behavior permits that. And that we saw during 2020, a lot of us, a lot of people who knew that it was a good time to invest could not because of job losses, either job losses or, even if you were in a job that time, there was a lot of uncertainty whether this job will continue, so on and so forth. So that's a very important point made. But people who continued their SIPs kind of, could fight that mental barrier as well as continue investing and benefit more or less from the dip that happened. So, Mr. Harish Rao, coming to you, I will go back to something that I mentioned in my intro, is that I have personally come across cases where people know of SIPs, but they do not know where or which instrument they are investing in. So, for example, many people mistake monthly premiums for insurance policies for SIPs. I mean, they are a systematic investment plans, so to say, but not in mutual funds. So, how does one get around such situations?
Yeah, that's a very, very pertinent observation, Nidhi. I only hope that it was ignorance and not mis-selling. If it was mis-selling, then it is a malicious act meant to mislead the investor. Okay, then of course the investor has to come down very, very heavily on his advisor or intermediary or distributor or broker or banker, whoever has initiated this very terrible act of labeling it as an SIP, but actually, under disguise doing it as doing an insurance sale. In fact, I've come across this 2-3 times in which an investor has told me a particular AMC has given very poor returns in their equity scheme. So I told it's not possible. The markets are doing well and the AMC you mentioned is a good AMC. Then they told me the name of the scheme. I told I've not heard of this scheme. So then it turned out it was that AMC's insurance arm, they share the same parent. Insurance arm has, sold us, they've been sold an insurance scheme, but the investor or I don't know, the advisor has given an umbrella name of the parent or the sponsor and, cloaked it as an SIP or a mutual fund. When true, even the insurance is market-based, it is unitized. He gets an account statement. So the investor was under the impression that, it's a mutual fund that is underperforming badly. So I had to explain it's not a mutual fund, it's an insurance scheme. There are, front-ended charges that have been deducted and, that's why you're not getting the XIRR that you wanted. Okay, so I told, please go back to your, the relationship manager who missold it to you and you're fully within your right to escalate it. So this is my advice to the viewers. Please escalate any case of mis-selling, both within the organization and with the industry association also. So if you have been missold a mutual fund, of course, you can take it up with the mutual fund concerned. You can take it up with AMFI and you can take it up with SEBI if it is very serious. And similar with IRDAI in case of insurance mis-selling. And of course, the investors and the viewers are cautioned to select their advisors and intermediaries with great care. And, people who have, integrity, who have honesty and trust. That's, I think, the simplest solution for preventing such type of things, Nidhi.
Right. So that's a very, very pertinent point, and our viewers should definitely keep that in mind, that if you are missold, there are ways to, reach the authorities and do something about it. And the first step, of course, is awareness about where you are investing, whether it's insurance or something else or mutual funds. So SIPs is something, it's a disciplined investment, but SIPs in general, when the financial industry mentions it, it's in the context of mutual funds and not other products in general. So coming to the end of this discussion, I think all the speakers have thrown adequate light on what SIPs and mutual funds are and how they can benefit us. But the last question, I will give it to you, Mr. Rao. SIPs are often also referred to as wealth creation tools. And why is that so? that will be the, apt ending to this discussion.
Thanks, Nidhi. Very interesting. I mean, how the SIP can become a tool for the wealth creation. Probably, somebody said wealth creation is a journey, and you need to continuously stay invested, and that's a journey. And if the wealth creation is a journey, SIP is a frequent flyer. And you are there, you're always onboarded. I mean, I quote, like, it's a, I mean, let me understand, when we want to create a wealth and we know it is the regularly you need to invest and stay invested. I mean, and what are the impediments coming in our path of wealth creation? Is it the market creating a wealth? Is it the discipline of staying invested wealth creating the wealth? And is it the market behaves differently, or is it the individual behaves differently? I think I can quote this as a Benjamin Graham, I think, who said that investor's chief problem is, I mean, and his own worst enemy is his own mind. When I am putting my money in SIP, I don't need to look at how the market behaves. My money continuously growing. That's where, I mean, both the speakers, Harish and Amit, was mentioning earlier, which is automating investment. And second part, I say it's like, I think Peter Lynch, again, part of the same book where he has written about, it is not timing in the market. It's a time in the market is the most important to create the wealth. I mean, if I want to have that, I don't want to timing, and time in the market is SIP is the one which always makes me stay put, and so that my wealth creation journey happens. I am not putting a break to my wealth creation. Rather, even, I'm sometimes I may be accelerating my wealth creation in that journey. That's and because market corrections will make me little accelerating my one. I mean, earlier, as Harish Bhai was talking about, step up SIP or value SIP can make you that journey of wealth creation happen a little more faster. I think Nick Murray, who always, who has written about in a big way on the wealth creation, is there are three things which are the tools of wealth creation, which is faith, patience, and discipline. And when you have a faith, the markets will do well. And when you need to have a patience, then you stay invested. And SIP is the way which will create a discipline, which can make you better. Put it in a power of compounding way. I look at, just a simple mathematics. If somebody is saving 500 rupees a day, I mean, in a month, I mean, if that can be for 15 years, means, every month you're saving around 15,000 rupees, 15 years, and 15% power of compounding, which can give you roughly, that is a 1 crore calculation, an arithmetic one. I mean, that's where it can look at. Means if you want to create a wealth creation, that's where you need to stay invested, whether you are doing a SIP monthly, or stepping SIP, or we call turbo SIP, or sometimes we call freedom SIP, sometimes we call value SIP. These are the various tools which can make you get there. And anything when you are to create in the wealth creation journey, making simple and have the integrity with your investment, and have that it can get progressed with your patience. I think SIP is a tool. I mean, SIP can give you simplicity, integrity, and the progress. That's the wealth creation of SIP. And for me, I look at wealth creation is SIP, save wisely, and invest rightly, and plan smartly, so that your wealth creation does happen. And I also wish audience a very happy new year 2025. And 2025 incidentally happened to be the year of squares, and year of multiple cubes of it. It's a 1 to 9, 1 square, 2 square, plus 3 square till 9 square, it becomes 2025. And 45 into 45, 45 squares, it will become 25. That way, let the year 25 can be multiply your joy and multiply your wealth. Thanks for this session, Nidhi. Thank you so much. And it's a glad I'm part of this webinar.
Thank you so much, all of you. And on that note, on a positive note, that your wealth will multiply, provided you are patient and a little strategic about it. Thanks a lot for this very informative session, gentlemen.
Thank you. Thank you.
Thank you.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.